Okay, let's take a look at what we have here in problem 1. They tell us this is the income statement and cash flows from operating activities of the statement of cash flows are provided below. The merchandise inventory count neither increased nor decreased. Okay, so we don't have to worry about that. That's good. They had no liability for insurance, deferred taxes, or interest, which means they had no insurance payable, taxes payable, or interest payable. So that's important. Okay, and then it says, based on this, prepare a schedule to reconcile our income. So it's basically asking us to fill this in, okay? So let's take a look and fill this in appropriately. I'm going to get the as big as possible so you can see what I'm doing here. So if we cut out some of the title, you'll just have to deal. Okay. So let's take a look. Go back and forth here. Let's pick out the pieces we need first. Okay, this is by the direct method, so we need to go and take a look at the indirect method. So we're going to need net income, 21.2. Okay, we need that. So what else do we need? We need depreciation expense. We need depletion expense. And do we have any gains? Yeah, we have a gain and a loss, okay. Gain on sale of equipment and loss on sale of land. Okay, so we have to, so we know we need those 5 things. So let's go transfer those over while we remember. Okay, so net income, 21.2. And depreciation expense, 12, we add that. And depletion expense, we have to add that, and that's 3.8. So we got that, we're taking care of that, we're taking care of that. The gain, we have to add, we have to subtract out of the operating section, put below in the investing section. So the gain was 21, so we need to subtract that. And the loss was 6.6, so we have to add that. So that's a start. Now let's go through and take a look. Accounts receivable. Cash received from customers was $235. Sales was $282. The difference between the sales and what you collected is called accounts receivable. Duh. 47.6. So our accounts receivable went up 47.6. When accounts receivable goes up, cash goes down. So let's take a look at our, they tell us that nothing happened to inventory, so we're good there. Take a look at our accounts payable. What we paid minus, so we have cash paid to suppliers of 162. And we have cost of goods sold of 173.2 is our cost of goods sold. We paid 162. So what is that, 11.2? And the difference between what our costs were and what we paid was accounts payable. And accounts payable went up, so cash goes up. Salaries payable. Let's take a look at that. Salaries expense, 37.4. Cash paid to employees, 34. So 37.4 minus the 34 that we paid, 3.4. That's our increase in salaries payable. Payable goes up, cash goes up. Now let's take a look at our prepaid insurance. Our insurance expense, 17.3. I'll label some of these: salaries, sales, accounts payable. This is accounts receivable. So now we're taking a look at our insurance. Our insurance expense for the period was 17.3. Our cash paid for insurance was 13.6. So the difference between those had to be prepaid insurance, 3.7. So that's a decrease in prepaid insurance. Cash goes up. Decrease in bond discount. That's insurance. Let's take a look at our bond interest expense and cash paid for interest. Bond interest expense was 10.9. And cash paid for interest was 9.7. So that's 1.2. And if we had extra bond interest expense but didn't pay it, that has to be the amortization of a discount. So the decrease in the bond discount increases our interest expense, but not the amount of cash that we had to use, okay? So the difference between 9.7 and 10.9, 1.2, decrease in bond discount. So it's part of our interest expense, but didn't cost us cash. And last but not least is our income tax payable. Cash paid for income taxes is 11. Our income tax expense, 21.2. The difference between those two, 10.2, is the increase in tax payable. Do the gazintas and the gazaltas, and you come up with 4.7, and that is the reconciliation from the income statement and the statement of cash flows by the direct method to the indirect method.